I guess we can now call it a trade war. I mean, $200 billion in tariffs. This really does up the ante.
It certainly does. And unfortunately, we had just gone through a period of time where coming into the official enactment of $34 billion worth of Chinese goods on Friday was met in the market with actually a pretty positive reaction. The S&P 500 is up, at or about 3% from Thursday to coming into yesterday's close. And I think that's a bit of, I like to refer to it as Stockholm syndrome, where we've, clearly the market's held captive by trade and trade policy, but we've actually got to a point to say, well, if this is as bad as it's going to get, perhaps we're going to be okay here. There hadn't been any rhetoric around escalation, and then the market closed yesterday, and that all changed. So this takes us back to trade being the major headwind in the market, which is unfortunate because we're coming into a catalyst-rich environment in the earnings season where we could actually focus on some really positive earnings coming up for the second quarter here. And I think that's going to get waylaid here. I think we're going to get back to be concerning about how bad this gets and what the retaliation now will be from China and how economic this turns. That's the most important part here. It's not, it's not as though we look at this and say, okay, there's an end game here, or Eamon Javers just said, there's an off-ramp somewhere. We just don't know where that is, and that can really turn economic. Corporations will delay spending decisions while we're in the middle of this negotiation process, and that's where things get very tricky.
That's very interesting, Art. So for the last couple of days, it seemed we've seen the market move higher 4 days in a row, that earnings were ultimately going to win out, that this trade situation was going to be compartmentalized. But now you see that potentially could be changing with this new $200 billion worth of tariffs that Mr. Trump is talking about instituting against China.
Yeah, Courtney, that's a really, really good point. This market, if not for trade, really has a tendency to want to be higher than this. And we saw that over the last several days. We almost got to a point where we said, okay, now we can compartmentalize what trade looks like, and it's not that bad. And here we are. Without escalation, the market has some very strong fundamentals. A great jobs number on Friday. The NFIB yesterday came in very strong, and certainly looking at 20% earnings plus for the S&P 500 for the second quarter, second consecutive quarter in the 20% range, third quarter double-digit earnings growth. So all sorts of positives that we could be focusing on if not for trade. But unfortunately, this is the hand we've been dealt. So this is a market that's going to shift back to that focus on trade. What's the worst case scenario and how economic does this become? How much of that corporate spending gets delayed in the second half, and how much this could potentially slow down the global economy if this continues and persists and escalates?
Quick look at the bond market, Art. This talk about the inverted yield curve, flashing signs of a recession. Is that too premature of a risk for investors to worry about, or do you think that is something that investors should keep an eye on?
Yeah, well, 9 out of the last 9 recessions were preceded by an inverted yield curve. So obviously it's got a very good batting average as a predictor, and in real sense with the amount of leverage that we have in the economy right now, it probably causes a recession. The tricky part of that is if you look at the last 3 examples of the yield curve inverting, it took about 20 months later for the recession to start, and in that time frame, the S&P was up some 30% on average all 3 times. So it's not immediate, but it's certainly something we have to keep an eye on. Unfortunately, it's hard to know. The last 3 examples happened in a rising interest rate environment. I mean, in a falling interest rate environment, we're in a rising interest rate environment, so that's modestly different. We've also had 10 years of Fed intervention in the bond market, so it's hard to know if this, perhaps has got a different dynamic to it. But with a 28 basis point spread between the 2s and the 10s, much too close for comfort, and we're going to keep a very close eye on that because it's got a great track record for letting us know bad things are in the horizon.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.